Hi, this is James Eng, and today I'm going to start with this quote from Howard Marks. He said, we may never know where we're going or when the tide will turn, but we had better have a good idea of where we are." And so today we're going to talk about where we are and where we are in the credit cycle and how this compares to 2001, 2008, 2020, and then how to invest in the scenario. So my background, I've done about 1.5 billion commercial real estate transactions. Half of that was underwriting commercial real estate properties at G Capital, and the other half has been loan originations across multifamily properties the last 5 years and investing in close to 6,000 units across DFW, Austin, and San Antonio. So let's jump in. This first chart is really 10-year treasury minus the 3-month treasury. It shows the yield curve inverting every time before each one of the previous recessions, right? So, in 2000, before the 2001 downturn, before the 2008 downturn, and then also inverting right in 2019. And so this is just sort of figuring out where we are in the cycle. So that's one indicator. Second indicator is really just looking at where we are in terms of the Dow, the 2001 downturn, 2008 downturn, and then how much the market has fallen here in March and April. And then this just came out yesterday, just in terms of the excess supply of oil and the price of oil just dropping, I think over, close from $60 a barrel just earlier this year, all the way essentially down to $20 or less than $20. Um, so I wanted to take it from the perspective of the credit cycle and, where we are in the cycle, on the upside, right? So essentially periods of prosperity, there's a lot of capital available. There's no bad news. Risk averseness disappears, and then more financial institutions provide more capital. And then eventually at the top of the cycle, lenders drop their returns, lower the credit standards, and provide higher LTV and ease covenants. I would say Fannie and Freddie held to sort of 125 debt service coverage, whereas a lot of bridge lenders looked more pro forma and pushed the envelope on their LTV. And so we're slowly moving. I sort of drew a line here. We're slowly moving to the other side now, where losses are going to start causing lenders to become discouraged and shy away. There's an increased level of risk from the lenders. Interest rates, credit restrictions, covenants, and requirements are going to come along with it, right? We've already seen Fannie, Freddie come out with debt service requirements. We've seen higher interest rates. We've seen JP Morgan, just on the single family side, increase their credit restrictions on single family homes. And essentially that's going to make less capital available, right? And so it's only going to go to the most qualified buyers. So to me, we're right in that number 2 and 3 zone in that credit cycle. And eventually companies, investors are going to become starved for capital, and they're not going to be able to roll over their debts, which is going to lead to defaults and bankruptcies. And that's going to add to the economic contraction, right? So as people can't refinance their loans, as higher leverage loans come up for maturity, it's going to take a while for these loans to come through, but essentially it's going to lead to defaults and bankruptcies. And then what's going to happen is essentially people are going to come in and say, look, I'll give you a loan at not 5%, but 10%, right? So it's going to be some of that rescue capital that's going to come in. They're going to receive higher returns. And that's going to lead to more and more capital providers. And then we're back to the top of the cycle, more providers of capital. There's not as much bad news. And then it's going to lead to the same thing. So, but this was a snapshot just from the story I received today. CRE lenders are feeling the squeeze on liquidity. And that's more talking about their ability to give out loans. A lot of these lenders, especially bridge lenders, are on credit lines from different banks. And so if their collateral that their loans are based on decreases, they can't lend out as much and they have to put up more equity. And so we're right in that downside of the credit cycle where less capital is available for the most qualified buyers. And so I went back and looked at Howard Marks's, if we think we're 2001, 2008, how does that compare? And in terms of where we are, right? So in those old memos, he said, look, consumer psychology has been damaged. Lenders' willingness has been damaged. Even investor confidence have all taken a beating. But within, the failure, the seeds of success are there. And so how did he recommend investing, right? So as you move into the last stage of a bear market, everyone agrees that things can only get worse. So right now, everything you read in the news is worse. It's coronavirus, it's oil dropping, it's foreclosures, bankruptcies, businesses shutting down. Like everything is negative. Optimism is thoroughly lacking, and the greater long-term risk is probably not investing right now, right? Because you can buy assets at prices that reflect little or no optimism. Um, so his formula for investing during a time like this is really, number one, have a firm, well-reasoned estimate of an asset's intrinsic value. Number two, recognize when that asset price falls below and buy it. And then even if the price goes lower, keep buying. And then eventually you will be right about the value. And so in a few years, he wrote this in 2008, in a few years, we'll reminisce together about how easy it was to take advantage of the bargains. And so here I took, there's a lot of data providers. I took this out of Yardi, essentially looking at A, B, C, D properties in DFW and looked at the last downturn. All right. And so let's start in the bottom right. You can see GDP goes negative, 2008, 2009. And GDP is going to be negative for 2020 Q1. It's going to be negative for Q2 2020 as well. And so 2 quarters of declining GDP. And so if we look back at that section, really, look at the discretionary, which is, your A plus product. That A plus product was started at 135 a door in 2007, dropped to 110 a door in 2008, and in 2009 was 82 a door on average. And then it really came back, 2010, 11, and 12, and then ramped all the way back up to about 170 a door on average in 2019. Let's go to sort of where a lot of people play, sort of that B space. And it was essentially flat, like 2008, 2009, 2010, 2011, stayed about 80 a door on that sort of B plus range class, and then really didn't take off to 2012, 13, and 14. And so part of that could just be that, those properties weren't in lease up, they were already stabilized, and they sort of weathered the downturn. So I'm hoping that Class B stays the same in that regard through this downturn, in that it's already full. We're already seeing people collect rent at 95% in April. So, I mean, I think it's there in terms of pricing. So we haven't seen really Class B discounted heavily. What you do see is sort of on the lower end in 2008, I mean, pricing essentially averaging about 20 a door. 2007, 2008, 2009, that lower workforce housing, sort of C, D class, and it really exploding over the last 5 or 6 years. And so, as we look to this, I think a couple of takeaways for me is really, I think properties in lease up 2021, 2022 are going to have issues, and there's going to be opportunity in that space. But then I think the Bs are going to ride through this pretty well. There was only maybe a 5-10% discount on the B stuff through the last recession. And so I think when you're waiting to look at properties, making sure that you have some sort of discount when you go in to buy, but I don't think there's going to be that larger discount on the B stuff. It'll be interesting to see sort of on, before we jump to the next slide, it'll be interesting to see on that lower workforce, sort of that CD product. It's gone from 20 a door all the way up to, 2019 was averaging 65 to 70 a door. So that almost 3 times the price from where it was in the previous upcycle. And so I think the top and bottom are things to be looking for. The B stuff, I think, is going to be pretty consistent. It's essentially doubled, but I think there's going to be more hurt on the A and sort of C class than the B on this particular cycle. So if you like this video, like the video, subscribe to the YouTube channel. And then if you want to talk about any potential new deals, selling a deal, refinancing your next deal, you can reach out to me at my email or phone number. And then to see all my recent loan closings, you can go to txmultifamily.com. Thanks.